Welcome to our Taking Stock video for the week ending the 24th of November 2023. I'm Kien Trinh, Head of Research at Stock Doctor, and today I'm joined by our Equities Analyst Daniel Ortisi to stream to you all things share markets. We had our Christmas party yesterday, and Dan, it's great to see that you've recovered well.
Yeah, no, celebrating early, Ken, because it will be a busy festive season for us. So good to be joining you today.
Yeah, the year has passed so quickly, and what I love about Lincoln here is the great team culture where everyone can also come together for a few drinks and nibbles. And we had a few games of bowling, and competition was fierce. So please, I hope you don't mind if my voice is a bit croaky today. But before we get started, just a quick yet important reminder. The information we provide today is of a generic nature and therefore shouldn't be considered personal advice. Remember, shares are volatile, so any past performance figures shouldn't be relied upon as a guide for future performance. Well, Dan, I also have some exciting news for our members. And next week, we'll be releasing our Stock Doctor Enhanced home screen. And the new design will provide you with our latest expert insights, market movements, portfolio performance and risk statistics. It will also have watch lists and alerts and recent star stock updates, all on one page. So you'll have a comprehensive snapshot of the things that matter most to you in the markets. And this new home screen is not just about us being dynamic and innovative, but also it's about our commitment to you, our valued members, to provide you with the tools to empower you with your investment journey and success. And I look forward to seeing this new screen next week. Very exciting development, Dan.
Exactly, Kian. And very important part that you mentioned are those articles that we're going to be producing. So hopefully members find that really interesting and engaging.
Yeah, and those articles will be talking about markets, but it was quite a fairly muted week for equity markets this week, with inflation and interest rates still on the radar. And minutes from the RBA released this week, it indicated that the board remained concerned about the persistence of underlying inflation pressures, and that's caused by a lack of productivity growth, wage pressures, and aggregate demand exceeding supply. Hence, they are prepared to raise interest rates in coming months.
Yeah, exactly right, Ken. And although the cycle, there are signs that it appears to be peaking. Like you mentioned, the market is prescribing a chance that at least one more rate rise could occur in March 2024. This, of course, will continue to put pressure on those financially weak businesses with high debt costs and unstable cash flows. In fact, there were over 900 corporate insolvencies in October, which was a 91% rise from the same month a year prior. This is certainly a trend that we anticipate to continue, Kian.
Well, that's a large figure, Dan, and certainly something that we're watching very closely because you want to be holding those high quality, financially healthy stocks in your portfolio during this time. But rising interest rates have also dampened retail spending. And this week, we've been keeping a close eye on X-Star stocks, footwear retailer, Accent Group, and also fast fashion jewelry maker, Lovisa Holdings. And despite displaying strong operating metrics under Golden Rule 1 and Golden Rule 2, we have refrained from including these stocks into our star universe, and that's due to heightened risks around consumer spending and the lag impact of steep interest rate hikes. And these risks have continued to impact Accent Group, which was sold down by about 10% after the company reported a deterioration in their like-for-like sales for the financial year to date. And also cost of doing business rose as inflationary pressures moved up higher while their wholesale channels remain a challenge.
Yeah, absolutely, Ken. A great overview of some of the pressures at the moment for these retailers. And meanwhile, when we look at Lovisa's share price, it did fare better, despite the business reporting a 6.2% drop in like-for-like sales during the first 20 weeks of the financial year. Earnings growth is expected to be supported by its global store rollout, and Lovisa currently has around 836 stores, and we did notice that appears to be tracking below consensus expectations for the first half. Therefore, we do feel like that aligns with our near-term view that perhaps the rollout assumptions from consensus might be a little bit too optimistic in the near term.
Yeah, very interesting, Dan. I mean, Lovisa appears to be one of the few retailers with a positive outlook still. And the store rollouts are helping the business in achieving strong earnings growth and return on equity numbers for the coming year. And we are currently reviewing the stock to see whether the share price weakness over recent months has factored in these risks. one of which is also the excessive remuneration being paid to its CEO.
Yeah, furthermore, Kien, over the week, we also saw rallies across the large resource stocks after China declared funding support for a group of their troubled property developers. As we know, the property market experienced steep price falls in recent months in China, and authorities are now scrambling to improve consumer confidence. Stimulus measures from China have been large contributors to the strength in iron ore prices, which, as we mentioned, is supporting these Australian miners for the time being. However, we continue to be cautious given the underlying data that we can point to, such as manufacturing PMIs, new housing starts, and of course, house prices all remain negative for the time being. So we're assessing potential opportunities in the resources space, but are unlikely to reinitiate on any of these iron ore majors, given we believe that the recent share price strength is not factoring in potentially higher inflationary pressures on its cost base, increasing CapEx requirements, and also the potential for growth in China to slow down.
Yeah, we've got to be very careful in the mining sector, Dan. But onto some of the company updates this week. We had corporate software provider Technology One. They announced their full year 23 results, and performance over the period appeared in line with consensus expectations, and management brought forward their guidance of achieving 500 plus million in annual recurring revenue for financial year 26, and that's moved to financial year 25. So what were some of the factors that drove this performance, Dan?
Yeah, management has done a really commendable job migrating the existing customer base from those legacy licenses to the software as a service product, which has improved the quality of the company's revenue and also its earnings base, Kien. Positively, it has lifted the recurring revenues to over 90% of total revenues right now, which does provide management visibility of the group's near-term performance.
Yeah, that's a characteristic of a high quality business when you've got so much recurring revenue, hey, Dan, and making your clients quite sticky. But with such a seemingly positive announcement, why was the share price reaction so muted?
Yeah, good point, Ken. It does come back to expectations. So based on the consensus forecast, the market was already anticipating this annual recurring revenue to exceed 500 million in FY25. So most of the positivity did appear to be priced in. The share price is trading close to fair value, and outside of any M&A opportunities, the growth trajectory is getting pretty well accounted for within the business, Ken.
Yeah, certainly our analyst Jason Yin will be reviewing the stock, but this week we would like to introduce an emerging opportunity which can be found using the Stock Doctor filter tool, and the company's called Supply Network. The code's SNL. It is a seller of truck and bus parts under the Multi-Spares brand, and the performance metrics appear outstanding, with return on equity at 40% and net profit margins over 10%.
Yeah, exactly, Kien. It's a business we've got asked about a few times on Lincoln Live, so it's good to do a bit of a deeper dive. What we did notice is that its competitive advantages appear to lie within its leading size within that part distribution market and well-stocked distribution centers, which means the company can deliver parts with industry-leading turnaround times. The gross dividend yield also looks relatively attractive enough for income investors. However, they need to be mindful that the stock does have low liquidity, with an average daily trade of around $150,000.
Yeah, that liquidity, it's also held back largely by insiders who retain about 48.5% of shares outstanding. Also, the CEO and chairman, they both have around 1.65% ownership, with additional related interests, including shares owned by their family members that cumulatively reflect significant skin in the game. Looking ahead for the corporate calendar, it's going to be quite a quiet week on the results front, although a few star stocks are expected to host their AGMs, including gold producer Capricorn Metals and rare earths miner Lynas. So we'll be looking out for that next week. In Under the Microscope this week, we take a close look at Karoon Gas's US acquisition that was announced last week. And for those unfamiliar with the company, Karoon is a mid-tier oil and gas producer and explorer with a major producing facility in Brazil. So, Dan, what can you tell us about the US acquisition?
Yeah, Ken, Karoon is set to acquire about a 30% interest in the offshore Who Dat and Don't Patrol assets, which are located in the Gulf of Mexico in the US. The acquisition purchase price was around $720 million US, and management does believe that the acquisition will be earnings accretive in calendar year 24. Importantly, what we do note is that it will diversify Karoon's current geographic exposure from being 100% focused in Brazil to around a 30-70 split between the US and Brazil.
I guess, Dan, it also de-risks the company's production profile by adding a second asset and extending its production mix with the addition of gas. So with Karoon now in satisfactory financial health, will the deal affect the financial health of the business?
Yeah, good question, Kien, and one that we obviously always focus on when these acquisitions are made. What we do note is that Karoon will report the acquisition on an equity accounted basis, given that it is acquiring a minority stake. So therefore, it won't actually add the value of the assets and the liabilities onto its own balance sheet. Therefore, we do not feel that the impact to its financial health will be high. Furthermore, we do note that the company isn't really using a lot of debt to fund the purchase. Hence, gearing levels are expected to remain moderate post-purchase.
Oh, that's great to know, Dan. And the share price is down by about 10% on the back of the entitlement offer being less than the last traded price when it was announced. The stock is now trading at a significant discount to fair value. So what should members be aware of when considering if the entitlement is suitable for them?
Yeah, well, the first thing, Ken, is the actual valuation that is calculated, because there will need to be some changes made for the acquisition, and the analysts will therefore need to update their models. Another factor we have to consider when valuing Karoon is the recent volatility in oil prices, which of course do drive the long-term price assumptions for a company such as this. So looking at the stock as a potential opportunity, investors will need to make judgments on whether they have a view on oil prices remaining higher for longer. What we do note is that the non-renounceable entitlement offer is around a 1 for 3.75 shares at that $2.05 price, representing a discount of around 6% on the previous close. So the acquisition, we believe it was well received by the market, Kien, given the actual size of the raise required. We also do note that, as we've mentioned, it is going to decrease the single asset operating risk of Karoon, and the geographical diversification is a positive in our view.
Yeah, fantastic. And I believe the Lincoln Australian Growth Fund, they took advantage of their full allocation as well. For members still deciding whether or not to participate, if the $2.05 offer price represents a healthy discount to the share price, it might be worth considering. Remember, the retail entitlement offer, it opens Thursday, the 23rd of November, and closes on Wednesday, the 6th of December. So there's a bit of time for you to jump in.
Also, Ken, we also get typically questions around the difference between Karoon and a company like Woodside Energy, which a lot of investors are more comfortable and familiar with. In essence, what we would take away is that Karoon represents more of a growth runway due to their smaller size, and therefore the ability to add assets into the portfolio will represent a higher percentage of growth. Woodside, of course, on the other hand, is the large incumbent in the space, and it also has a higher percentage exposure to LNG. And keeping in mind that we do note the business obviously doubled in size following its merger with BHP Petroleum last June.
You're a very big business now, Dan, and Woodside's biggest growth project and a key active risk is also its investment in the Scarborough gas project in Western Australia. And this investment continues to face backlash from environmental groups and also ongoing legal disputes. So our team are closely monitoring the situation here too. Now for question of the week. Under Golden Rule 2 for resources, we refer to the trend in return on invested capital, but for financials and industrials, we look at return on equity. So Dan, what's the difference here?
Yeah, well, to answer this question, Ken, you really do need to understand initially what invested capital is. And effectively, it is the assets that a businesses use to run the company. Or in essence, it can be your total operating assets minus liabilities that don't earn interest, such as things like accounts payable. In finance, we tend to refer to this as your net working capital, plus property, plant, and equipment. And of course, if there's been acquisitions, goodwill and intangibles.
Yeah, breaking it down like that makes it so much easier to understand, Dan. And the return on invested capital is then calculated as the net operating profit generated by this invested capital. It gives a good indication of a company's actual capacity to generate returns through the utilization of its productive assets. Hence, it's useful for resource companies which tend to be capital intensive and have significant future capital expenditure as well.
And when we look at return on equity, we do note that this captures the return from a company's equity base, which is its total assets rather than operating assets minus liabilities. So in other words, it's trying to measure how efficient shareholder capital or equity is being used to generate profits. It is useful for financials and industrials because these businesses today tend to provide services and are less capital intensive.
That makes sense, Dan, but we've got to be careful here though. Return on equity does have some limitations. For example, it can be inflated by debt. Hence, it's important to understand the financial health of a business in combination with assessing return on equity. It also tends to be weighed down by businesses that have high capital requirements as well. Well, that's all we have time for today. Thanks, Dan, for your insights.
Now, great to be here, Kien, for another week of taking stock.
And remember, the Stock Doctor Enhanced Home Screen is expected to be released next week. So look out for our communication on this. And if you have any questions, feel free to call us for a chat. And better still, please come along to our Lincoln Live webinar on Monday, where we answer any of your queries on stocks, the market, or using the Stock Doctor platform in general. So to summarize today's episode, the significant rise in the number of corporate bankruptcies in recent months suggests that investors should stick to those quality, financially healthy stocks and be careful about chasing the rally across those major miners. And lastly, return on invested capital. It is a better measure than return on equity for those capital-intensive businesses such as resources. Take care and have a happy, healthy, and prosperous week ahead.